Hi, everyone. Good evening again. Yeah, thank you all for joining us today for our mid-year outlook. And we're very happy to have JP.Morgan with us today. So in the last few months, it's been a pretty tough environment for most investors. And in today's day and age, right, we have a lot of data, but perhaps not as much insights. So today we have Clara here to share, the macroeconomic outlook for the rest of 2022 and beyond. As well as for investors, what to expect and what are some pockets of opportunities in the space. Yeah, so, I think most of you would know Ritesh already, but I'm Grace and I lead investment research efforts at Syfe. So Ritesh, he heads investment advisory and he's a team in Hong Kong and Singapore, and you have, your advisors here today. Yeah, so if I can just quickly introduce, us, other speakers, as well as Ritesh will go into a brief overview of Syfe, and we'll hand it over to Clara, and then we'll proceed into a fireside chat component after her slides. Lastly, we'll take some questions from the audience, and so please feel free to, to raise your hand if you're live with us, and for those who are online, you can use the question option on Zoom. And then we'll hear from Dhruv a bit later on. But yeah, please, this is a session where it's for you to, for us to come and meet you, and also for you to get some of your questions answered, as well as hear from Clara, most importantly. Yeah, I think you guys probably know us already. So I think more importantly, it's for you to get to know a bit more about Clara. So Clara is an investment strategist at JP.Morgan, and she covers everything from equities to bonds to cross-asset investment strategies. And I think I always found her views really insightful because she came from being like a portfolio manager for private wealth. So looking forward to hearing from her, as well as seeing what questions we might get later.
Hey, Grace, thanks so much. And it's an absolute pleasure to see people in person over here. I think it goes back to like 2020, early 2020, when we held our last physical event. So really excited to see everyone in person here. Plus, I think there are hundreds of people who are joining us online too. So just for everyone's benefit, I think especially people who are joining in online and might not be Syfe clients yet. So Syfe is a digital investment platform, and our mission is to transform the way people manage and invest their money. Now, we believe in providing the best tools and resources such that people can improve their financial status as well as attain better outcomes in their lives. We are licensed in Singapore, so we went live in Singapore in 2019. We just launched in Hong Kong in June of this year as well. So that's our second market. And more recently, in fact, just today, we have launched officially in Australia too. So we are truly like an APAC player as we speak. So Syfe is a platform. So we are an all-in-one platform, basically, which can cater to all your savings and investment needs. What that means is basically if you're looking for a managed solution to kind of invest in a globally diversified manner without trying to dwell too much in terms of constructing of portfolios, you do that handholding. We do that handholding for you and manage your portfolios on a discretionary basis. So that's our managed solutions offering on the wealth side. We also offer custom portfolios. So this is something that is very unique to our platform, where you can choose your own investment style and construct your own portfolio from scratch. And then on top of that, we have introduced our trade platform, which allows you to pick individual securities and invest DIY basis as well. So what that means is basically we encompass almost all the needs that people will have, whether it comes to savings, investing, and trading as well. And that has been recognized, right? So if you look at some of the awards that we have won, the best digital advisory solution, the top tech fintech leaders, and more, recently the wealth management fintech of the year as well. In terms of our journey so far, it's really been a story of innovation. We have kept innovating and kept hearing and listening to our clients, because you guys have told us what is the missing piece, what are the things that you're really trying to solve for reaching your financial goals. And to that extent, we have continued to provide those opportunities for you. So whether it comes to savings needs, we came up with a cash management solution. Whether it comes to income needs, we came up with like a REITs portfolio. And more recently, we allowed you to, and took that thing further, a step further, by allowing customization to your portfolios. And on top of that, we launched our trade platform. Now, all of this will not have been possible without the feedback that we have received from you guys and the continuous improvement framework that we, work under. Also, we are very well backed. We have a total of USD 52 million raised so far through our Series B investments in July 2021. Also, we have expanded, right? So we expanded in terms of customer base. Just in Singapore, we have over 100,000 users. That's more than 5% of the adult population of Singapore. So really a good penetration. And that kind of, tells you the story that the adoption of our platform has been, far reaching in Singapore. But we are not stopping there. We are continuing to expand. So we launched in Hong Kong. And as I covered earlier, we are going to Australia too. So that's been our journey so far, but I think today's agenda is the market outlook. It's been a tough year to begin with, especially growth investing. I think over the last 6 months has been severely challenged. Even like broad-based indices are down close to like 20 to 30% on a first half basis. So I would again hand it over to Clara to give you much better insights in terms of what's happened so far as well as the outlook forward.
Thank you so much for the introduction, Grace and Ritesh. I'm Clara Cheong. I'm a global market strategist at JP.Morgan Asset Management. And thank you so much to the Syfe team for having me today, and also to the audience for joining us on a Thursday evening when you could have been at happy hour downstairs. So I really appreciate that. So I think, Grace and Ritesh, they've reiterated that it's been a really tough year for investors globally. And I think, the best way to really illustrate that is through this quilt chart that I love to use from our guide to the markets. If you look at the third column from the right-hand side, which says year-to-date 2022, you can see that nominal cash has really been the outperformer this year, and almost virtually every other asset class. Commodities is not on there. But look at global bonds and developed market equities, emerging market equities, all of those have been down pretty significantly. I mean, there's been a little bit of a rebound more recently, but nevertheless, we're looking at low teens negative returns on both global bonds as well as global equities. So, a lot of the times when I do client meetings, a lot of the clients would be like, is this over? Like, do we see more downside from here? What can we expect? And what do we do on a go-forward basis? So hopefully this presentation will allow me to share some of my insights as to how to navigate this journey on a go-forward basis for the rest of 2022. So turning to the global macroeconomic outlook, I think inflation has really been the buzzword of 2022, and it's really come back with a vengeance after being missing for a decade or so. And, admittedly, it's more of a developed markets problem, and you can see that in the top third of the chart, where places like the US is suffering from high inflation at the headline level of 8.5% as of yesterday's data, and it's also similar in places like the Eurozone, which is close to 9% or so, with the only exception really being Japan, which has really lagged in terms of the economic recovery due to its COVID circumstances. If you look at EM Asia, on the other hand, we are experiencing slightly higher inflation now, especially in some places like India, for example. But if you were to look at, the other biggest engine of growth, which is China, within EM Asia, inflation levels are still very much manageable across the EM Asia region as a whole. So on a look forward basis, if you look at commodity prices like oil, food, like corn, like wheat, all of those prices have come down pretty significantly since the end of May, where they have peaked. I think they're close to down between 15 to 20% or so. And that should lead to, on a go-forward basis, moderating headline inflation, both for the developed markets as well as the emerging markets, especially Asia, where we a lot of the countries here, they import a lot of food and energy. But I think the more interesting thing to point out is that I don't think this dynamic really applies to the Eurozone, because for the Eurozone and the UK, they rely a lot on natural gas, and specifically natural gas from Russia for power generation, right? And the Russia-Ukraine crisis is still ongoing. So I think, the fact that natural gas prices are still really high in the Eurozone will help to kind of push out the peak in the inflation that the Eurozone and the UK can kind of see going into the end of the year and next year. And then moving away from headline inflation to core inflation, I think this is a really interesting dynamic to point out as well, because on the left-hand side, you can see that inflation at the headline level can come down, but for the United States in particular, the core inflation number is still relatively high. And why is that so? Part of the reason is due to the very generous stimulus packages that they have, dealt out to their citizens over the last 2 years or so, that has a part in creating excess demand. And the other thing is on the right-hand side. If you look at wage growth in the United States, it's been pretty strong, at least, compared to the experience of the last decade, and also relative to its Eurozone peers and Japanese peers, as well as us over here in Asia, where wage growth is around 1 to 2% or so. So that's really contributed to a much more elevated core inflation picture in the US. And I think that is a risk, right? That core inflation continues to stay relatively high, even as headline inflation is coming down. And that could be a reason as to why the Federal Reserve could stay more hawkish going into the end of this year. So that's definitely a risk to look out for. So, with that inflation backdrop that I've painted, obviously, central banks have been reacting pretty aggressively since the beginning of this year. And you can see that from the left-hand side chart, especially in the US, which has really been a front runner in the hawkish policy tilt. But more importantly, on the right-hand side chart is to see what markets are pricing in terms of rate hike expectations. So, I painted the story that headline inflation can come down. Core inflation in the US is still relatively strong. However, we think a lot of those risks of the hawkishness of the Fed has already been priced in, because if you look at the gray line, it's basically pricing in the funds rate at the end of 2022 of 3.5%. In the United States, and we think that is pretty much fully priced, which means that the upside for government bond yields on a go-forward basis is going to be much lesser, at least in the United States. In the Eurozone, for example, which is the blue line, we have 3 more meetings left for the ECB, and given the fact that natural gas prices are still high and headline inflation can still stay relatively elevated in the Eurozone, we think that the risks are probably to the upside in terms of the market pricing of yields of 1% at the end of 2022. So that also translates to our views on being slightly more negative or bearish on Eurozone duration. And then, kind of transitioning from the inflation picture into growth, and, on the back of very hawkish central banks, you can see that, in the Eurozone, growth has really taken a hit. And over here, this is a screen that we like to look at that looks across various different indicators that are representative of the health of an economy. And you can see that in the Eurozone, for example, the manufacturing sector, the services sector, as well as consumer confidence, where the European consumer is actually 50% of GDP, all 3 of those indicators are already in levels that are consistent with previous recessions. And hence, the 3 red flags are flagging across the consumer services and the manufacturing sector. Financial conditions are very close to previous recessionary conditions as well, with the only exception being that the labor market remains relatively strong at about 6.5% unemployment, which is kind of similar to the US as well. On the next slide, labor market remains relatively strong, which kind of feeds to a strong consumer. So consumer confidence has fallen, but it's not really fallen that significantly yet into levels that are more consistent with previous recessions. But nevertheless, if you look at the direction of travel, comparing the blue diamonds and the purple diamonds, you can see that 6 months prior, the picture was very different, right? So there's definitely a deterioration of growth that's going on in the United States as well, even if a lot of these indicators are not really at risk of a higher recession yet. And I think that the market sees that. Because on this slide, this is a recession probability model that we run on a weekly basis, and you can see that the market has basically ingested all of these data that I've shared with you and started to price in a much more elevated odds of recession over the next 12 as well as 24 months in the United States. So really pivoting away from the dimmer developed market growth outlook outside of Japan into our part of the world, which is Asia. So China is obviously a big part of Asia, and the second quarter GDP growth was really disappointing. It came in at 0.4% real GDP growth. And if you look at the chart on the left-hand side, this is pretty much the lowest quarterly growth level that we've seen since the 1980s. I think a lot of people would find this really concerning, but if you look into the details of it, a lot of the weakness was really due to the Omicron-related lockdowns that's dampened consumer confidence as well as corporate confidence as well. But if you were to look on the right-hand side, because remember, GDP is a backwards-looking indicator. It tells you what has happened, not what is to happen in the future. But if you look at higher frequency measures of growth, like the purchasing managers indices that we track pretty closely, you can see that there's already been a relatively strong and sharp rebound in the July numbers, with both the manufacturing and services sector registering numbers above 50, which is indicative of an economy that's in an expansion. So I think, all really encouraging signs here. I know China is still grappling with the COVID situation and has, existing property crisis, but we do think that, eventually the government will step in and will step in strongly to help to, kind of solve these issues on a go-forward basis, such that it sets up China for a pretty strong second half rebound. And then, outside of China, within Asia as well, we are quite positive on the ASEAN region. And I think we've all personally experienced this as well. Singapore is a great example of a very recent reopening case. We all can travel now. There's been a bit of revenge traveling going around, and we're all going to restaurants. I'm sure we've all experienced how difficult it is to book some of the nicer restaurants in the city as well. So, on top of the fact that exports still remain relatively robust, if you look to the right-hand side, ASEAN has really lagged global ex-ASEAN in terms of the reopening, despite whatever phenomena that we feel like we're going through right now. So, in terms of the domestic recovery and the services recovery, I think that all bodes very positively for the Asia ex-Japan region as a whole. So, I think this is a good place to kind of transition from the macro outlook that I've given, taking into account all of the inflation and the growth dynamics of all these different countries, different regions, and translate that into what we think an asset allocation could look like, and how we can, best benefit from, the differing growth and inflation dynamics across different regions. So, like what I said, I think in the developed markets, the growth outlook is deteriorating. And, against that outlook, we've really been advising our clients to kind of tilt a little bit more defensive and seek shelter and income and get paid to wait as the macroeconomic uncertainty kind of plays itself out in the developed markets. And within fixed income, there's a ton of things to invest in. But if we look at our highest conviction ideas, it's really in places like high quality US investment grade bonds. And specifically, within US investment grade, we do like the short to intermediate term investment grade, because it gives you a really good yield of about 4 to 4.5% with only 3 years of duration risk. So we do think that the possibility of earning that yield is very high, given that defaults are pretty much non-existent in the high quality investment grade space. And then moving to high yield, we do like US high yield as well. We think it's a relatively interesting trade at this point. And obviously, sizing really matters, because if you do head into recession, then the natural question would be like, why are you investing in high yield? But if you look at the all-in yield levels now for US high yield, it's close to 8%. Right. And if you look at the fundamentals of the US high yield complex, it looks very different now than, the previous stressed episodes of 2014, when we had the oil price collapse. A lot of those bad companies in the energy sector, they've already been weeded out. If you look at interest coverage ratios, leverage ratios, they're all still really strong in the US high yield space. So, definitely I think that's an interesting one to be looking at as well. Definitely want to avoid European credit, just because, the growth picture there is a little bit more muddled. And then in terms of, China offshore credit, I think it's still worthy to be a little bit more careful there, just because, especially in the high yield space, because Chinese property is such a big part of that market. It's about 60% of the China high yield index. So, it's not to say that there are no opportunities. It's just that you have to really work closely with a credit expert to select those and avoid the worst default outcomes that is to come. And then for those investors that are still a little bit more risk-taking, global equities, I think it still presents a relatively decent opportunity set, especially if you look at how valuations have derated quite significantly across all of these different equity regions. I remember when I was giving this presentation in January, the green dots were all pretty much at the high end of the 15-year range. And, now they're much closer to the 15-year average or so, with, some markets like the US equity market even trading above the 15-year average at 17.6 times. So, I think this also is a reflection as to why we as a firm are more positive on Asia ex-Japan as a region. Because if you look at Asia Pacific ex-Japan, which is the third from the left-hand side, those valuations are trading below the 15-year average levels. And if you look at China A shares as well as China offshore, that's also trading below the 15-year average levels. And that is on the back of earnings expectations that have come down very significantly. So if you look on the left-hand side chart for Asia Pacific ex-Japan, the blue bar is pretty much non-existent because what market consensus is for 2022 earnings to be flat to negative for Asia ex-Japan, despite whatever that's going on with our growth situation here that is rebounding relatively strongly. And then if you look at places like Europe, for example, which is going through a lot of challenges in their growth environment, the 2022 and 2023 earnings are still positive. And so, we think that definitely has to come down. And then in the US, 9 and 8% earnings expectations are still way too high, especially, with economic data that's deteriorating. We do think that, that has a decent opportunity to come down as well, and that will have an impact on your returns. Even if you think that valuations are reasonable, if earnings were to go down, it's still going to suffer negative returns on a total return basis. So going into a little bit more detail on the United States, it's not to say that we hate the region. United States is still, equity market is still one of the highest quality equity markets. It has a high ROE profile, there's lower leverage, which is why it trades at a premium to a lot of these other equity markets. But, in terms of the earnings growth season that has just kind of concluded, I think about 95% of the companies have already reported. The earnings growth number year over year is negative 9.5%, right? And the biggest pain points are consumer discretionary, it's tech, it's communication services, and it's financials. And you're still seeing at least like the cyclical sectors, energy, and materials and industrials, those are still contributing positively and doing most of the heavy lifting in offsetting some of the negative growth numbers. But the drag from all these growthy sectors is pretty significant, at least on a second quarter basis. So I think it's increasingly difficult for us to meet the 8 and 9% target earnings growth that the market is currently pricing in right now. And then on the right-hand side, you can also see consumer discretionary, tech, communication services, I guess it's the anomaly. But if you look at tech and consumer discretionary, those are still trading at above historical average valuation levels, right? So I think there is definitely a bit of earnings risk in this market. And given that tech, consumer discretionary are big parts of the US equity market, I think it's important to be a little bit more careful here. And this is not to say that there are no opportunities in tech. I think it's important to differentiate profitable tech versus unprofitable tech. I think at one point in 2021, unprofitable tech was trading at 5 times of the return of the S&P 500. And that has reversed so very quickly, which is what contributed to the massive pain that's been experienced in these sectors on a year-to-date basis. But there are opportunities in mega cap tech, for example, that are yielding you 3+% on a free cash flow yield basis that is comparable to a consumer staple sector. But the only difference is that you get this 3% free cash flow yield, and at the same time you still have an opportunity to be experiencing the growth potential of this sector on over the next 5 to 10 years or so. So being more picky in the tech and consumer discretionary sector is the way to go if you want to be invested in US equities at this juncture. And then for Asia ex-Japan, I said earlier that earnings expectations here are already extremely low. And with China's recovery as well as ASEAN's domestic recovery, I think the Asia ex-Japan region is well poised to do well, especially for earnings rebound going into 2023. And something interesting about this index is also that it's highly cyclical. about 40% of the earnings of this index is comprised of industrials and financials. So if you think of the economic trajectory of this region, if we have not experienced the cyclical growth that the developed markets have, then being invested in a Asia ex-Japan equity index that has potential, that has more of a bigger weight towards cyclical sectors would be, quite interesting way to kind of capture this recovery in the region as a whole. And then lastly, we can't really talk about Asia without addressing what's going on in China. Over here, I want to be clear that I'm talking about MSCI China, which is the offshore index. And obviously, there's been a lot of challenges with the consumer discretionary and communication services sector because of the regulatory issues that has plagued this space due to the Chinese government's clampdown on these two sectors more broadly. And I think, a lot of that hardship has already passed from a regulatory perspective. I think now it's more of an implementation issue. And while we wait to get more clarity on this space, I think it's worth to be a little bit more careful in the offshore index, just because if you add up consumer services, communication services, and consumer discretionary, that's 50% of this MSCI offshore China index. So where we are a little bit more positive is in the A-share index, because the A-share index looks very different than the offshore index. The A-share index has the three biggest sectors being industrials, financials, as well as technology, which is focused on hardware. It's not the software companies that we often hear about. So if you think about what the Chinese government is doing now in terms of wide-scale infrastructure stimulus, to really drive growth in the second half, I think the industries that are really going to benefit, or the sectors that are going to benefit, are things like industrials, construction and machinery, materials, because infrastructure investment itself already accounts for 30% of cement demand in China and 20% of steel demand in China. So if we just think about how all of these credit facilities that the local government are going to be tapping into to build more infrastructure to support growth, then all of these other companies that are supplying the ability of these governments to be able to build more things, more infrastructure, are going to be the biggest beneficiaries of this effort. And then on a longer term basis, I think focusing on renewable energy sectors, electrification, those would be the places that would be aligned with where the Chinese government is trying to push China towards, which is new China, new growth, more sustainable. We don't want to be as pollutive as we had been in the past 20 years when we were growing aggressively. So, this again is just a visual that kind of shows you the benefit, even if you don't believe in all of these sector tilts that I've been talking about, the very fact that on the last line, the CSI 300 has, pretty much the lowest correlations between the Chinese onshore market and other equity markets, which I'm pretty sure all of us hold, that in itself is already a strong enough case to be invested in the A-share market, just from a diversification perspective, even if you don't believe in the growth story. So I think that's probably where I'm going to end. And hopefully that was insightful, and I will open it up to the Fireside Chat and pass it back to Grace.
All right, thank you. So we have a few questions that and get a few more after hearing Clara speak, but perhaps we can start with value versus growth. Right? So value stocks kind of had their moment earlier this year, and we saw a lot of flows, and they really seemed to hold up very defensively, relatively, particularly because energy was a component of that. But then more recently, we have seen flows into value be a bit more flat. Particularly as growth recovered very strongly in the last month. And you talked a bit about, the mega cap stocks that are kind of like bellwether stocks, right? Have held up pretty well. Could you share a bit more about, where do you see value versus growth, particularly some of these companies, growth companies, right? Given how valuations have fallen, they're starting to look a bit more like value. I think you were also making that point.
Yeah, so I do think that, it's worth taking a more selective approach here, like what I just mentioned, between profitable tech versus unprofitable tech. But I think if you're asking me about growth as a factor, whether I'm positive on it right now, would I go all in? The answer would be no. I think, for me, I would need to see economic data really deteriorate significantly such that investors are now willing to go back into growth exposures to pay for the growth that's missing in the economy. And secondly, I know we had one inflation print yesterday that, was lower than expected. Everyone was cheering about it, but I felt kind of burned by that in May as well. If you guys remember, like the numbers then were coming down. And then in June, we kind of had this huge shock of an inflation number that caused global equity markets to sell off pretty significantly. So for me, I think I need to really see that both the headline inflation and the core inflation numbers are really moderating downwards for me to have more confidence to go back into growth exposures so that I'm supported both from a valuation perspective as well as earnings perspective.
Do you have anything else to add, Ritesh?
Just quick ones. So, I mean, I totally agree with all the points that Clara mentioned as well. I'm just a bit more optimistic as well in terms of growth investing. But I think like the shift to value happened pretty much like late 2020 up to like, soared through the inflationary period and, soaring energy prices as well, coming into 2022 as well. But we've had a decade of, growth outperforming majorly, value investing. So in this year, coming in 2022, we suddenly see, value for the first half of the year more than 10% up compared to growth. Now, of course, as you mentioned, the data needs to be a little bit more persistent for us to know whether inflation is in fact actually moderating, or is it just like, temporary thing that we observe and you continue to see, maybe headline inflation coming down, but the core inflation not yet coming down. And I think the selective part of growth is a very important point, and that is something that we have been iterating to our clients very prominently as well, that differentiate between the profitable and the non-profitable tech. While if you see like the more, blue chip tech, NASDAQ, say 100, for the first half, say down 20 to 30%, but the unprofitable tech was down 40 to 50% or even more. And a lot of investors that I speak to had poured into growth investing, and especially these non-profitable growth investing over the last couple of years, and tried to ride through that rally. And they have been burned quite severely through this downturn. So it's important to kind of differentiate between the two and make sure, like, when you're investing within growth, you pick the more profitable growth with stronger balance sheets and cash flows, as Clara was mentioning. More from a long-term standpoint. So tactically, yes, I mean, from a allocation, I'm starting to see a little bit more allocation coming back to growth as we speak. But more from a longer term standpoint, if you look at Syfe and the way we construct our portfolios, we focus on diversification, and we do have multi-factor allocations as part of our strategy. So if you look at our equity, 100% equity portfolio, it's kind of gotten this blend of, growth as well as value. And what that means is essentially for the bulk of this year, we were able to capture the defensive part of the value sectors, but at the same time not miss out as the growth sectors rally towards the June month. Plus, we also have an allocation to China and the emerging markets, which kind of also contributed towards the rally that we saw in the later half of this year. So yeah.
No, I definitely agree with that. I think the time horizon of an investor really matters as well. There's this investment principle that's kind of been circulating around for a while. It's owning growth and renting value, right? Because value is cyclical, right? You kind of need to time it right to be able to, really reap the benefits of it. Just as Ritesh was saying at the beginning of this year, through the first 6 months of the year, value has been great. But over the longer term, you really want to invest in like the growth potential of these like tech companies, these consumer discretionary companies. It's worth kind of tracking them closely and legging in bit by bit, because ultimately those are the companies that you want to be invested in that will take like double or triple your initial investments over the next 10 to 20 years or so, right? It's not the value investment that's going to do that, because value is cyclical. Yeah, so renting value and owning growth is something that I would like people to take away, at least from this session.
Yeah, thank you. It's a very good saying. Yeah. Okay, so next one, I think you covered this already, but just recession indicators, I think they've just turned more pessimistic over time, compared to like the start of this year. But how deep, I think that the more important question, like if we do get into a recession, right, how deep do you think that could be? And what are some indicators that you could look at, to sort of make that determination?
Right, so I didn't include this chart and that we have in our 100-page deck in our presentation today, but there is a very good chart that speaks to this. So we looked at all of the recessions going back to the 1940s in the United States, and we kind of broke them down by each category. So government spending, net exports, investments, and the consumer, which is obviously the biggest part of the US economy. Historically, the first observation is that most recessions have been mild. Secondly, if you look at the more serious recessions, the most recent one being the 2020 pandemic-induced recession, the reason why it was so severe, it was because the consumer was hit so badly, right? Because think about it, like everyone was locked at home, they couldn't go to work. People were afraid of going back to work because in fear of contracting the virus and feeling really ill. And there was a lack of workers and women who had children, they had to take a step back and take care of their children at home. And, as a result, couldn't go back to work. So, if you think about that, that's not really the dynamic that we're seeing today with the US consumer, right? Like over the last 2 years or so, the government has dished out very generous amounts of stimulus and unemployment benefits to these people. They've built up a pretty significant financial cushion. So, and, household leverage is not high compared to like the 2008 crisis. So I think the consumer today is in a much better shape than before to kind of weather these higher energy prices and higher food prices that we've all been experiencing. So I don't think that the consumer is going to be dragging down the overall economic growth, at least for this recession, if we do get one. So already from that perspective, 2/3 of the economy still stays relatively healthy. So unless there's a significant hit to business confidence, which we don't believe will be the case as well, this recession should be relatively brief and relatively mild.
Yeah, sure. So I think technically, if you see from technical definition standpoint, we've had 2 quarters of negative GDP print, which, is a recession signal. Now, of course, you don't take that as official recession, because if you look at other indicators like non-farm payrolls and all that have come out very, very strong over the last week or so. At the same time, I guess on a look forward basis, there are some concerns coming in about unemployment and how that will pan out. We have seen in the more, again, tech world, a lot of layoffs and related news bites coming in as well. So these are things that, tell us that maybe if the inflationary pressures persist and potentially if there is unemployment related aspects that come in as well, then from a recessionary standpoint, and I think you covered it in your slide deck as well, that there is aspect of recession and actual official recession happening. The probability of it is maybe high. In terms of how deep will it be or how mild it will be, kind of depends on a lot of other factors as well. If you think about Fed as one of the key players in terms of determining whether they can engineer the soft landing, will be a key part of how they manage, because they have this dual mandate to kind of control inflation as well as keep the unemployment levels low. So I guess again, data still needs to come in the coming quarters and all, but looks like there is some thaw in inflation. There is a reversal that we are observing. And if that continues, hopefully, the Fed will be able to engineer what is called like a soft landing, and meaning that we'll have a mild recession coming in.
Yeah, and I think it's also important to think about why we're asking this question. Like, why do we care, like whether we get a recession or not? It's because there are implications on markets, right? Because equity markets are actually very efficient. If you look historically at all of the recessions that has happened and the market action, like prior, during, and after the recession, markets typically bottom even before or during a recession. And on average, that's been about 4 months into a recession and the markets would already have bottomed. And that would be 10 months before the end of a recession, right? So to the extent that we are tracking whether we are in a recession, so we also have an idea as to how much more downside we can see in the event that we do get a recession, and roughly what kind of timeline are we looking at to be able to leg back into the market as well.
That. Okay, so we have one more question. We have quite a few audience questions, so we'll get to that too. I wanted to cover, just from an asset allocation perspective, right? So the 60-40, like very classic portfolio, they have all done, it's been tough for like both, right? Because technically you're supposed to have, bonds and equities, they're negative correlated. So you have that diversification benefit. But looking at what's happened this year, right, your classic 60-40 is like down almost 12% so far. So where do you see, the idea of a 60-40 portfolio, like, in portfolio construction for back when in your role previously, so now at JP.Morgan with the asset management side. But yeah, do you think they're still relevant? How do you think of them, in this portfolio?
Oh, I definitely think that the 60-40 portfolio is still relevant. It's probably taken a little bit of an extended breather this year. But, I think let's look at what happened this year, right? Through the presentation, we know that inflation is the buzzword for 2022. For the longest time, an inflationary regime didn't really exist for the past decade or so. So most of the time, stocks and bonds, they were driven by news that were related to growth. Like, are we in a rising growth environment? Are we in a falling growth environment? But today, whatever that we've experienced over the past 7 months or so is a result of the fact that an inflationary regime has kind of dominated the growth regime because people are more concerned about what's going on in inflation. And then more recently, you started to see a little bit more of that pivot to growth concerns. But historically, if you were to run the numbers, and if you were to look at how stocks and bonds perform during inflationary regimes, they tend to be directionally the same, right? Which is why we experience what we experienced this year. Whereas, in the past decade or so, when a growth regime was dominating, historically, during different growth regimes, stocks and bonds, they are negatively correlated, right? So they move in different directions. And hence, in a falling growth environment, owning bonds will protect you and owning equities will hurt you. So on a go-forward basis, we don't really expect this inflationary regime to kind of keep dominating the news. And the way that we measure that is we can look at inflation volatility relative to growth volatility. And that has spiked up really significantly, but historically, we've also seen that consistent with the levels that we've seen in other high inflationary periods like the 1970s and the 1980s. So that's going to come down very sharply, we believe, in the next couple of months or so as the market pivots to worrying about growth. So when that regime comes back, I think it's where the 60-40 will come back to play again. And so, yes, I think unless we believe that on a go-forward basis, inflation uncertainty is going to remain very high and the Fed is highly unpredictable, which is not our base case scenario. And looking at inflation expectations, it really shows you that, right? Because it's been relatively stable, at least on the longer end. Yeah, so, because we don't believe in that, we believe that the 60-40 is still going to be relevant on a go-forward basis.
Yeah, no, so I think totally agree with that. At the same time, I guess, the diversification benefits that people do expect from a stock bond portfolio, that is something that, came as a little bit of a shock for investors in the current environment. And to that extent, I guess, like when we talk to clients and they are trying to kind of make sense out of, this, because typically, as you said, bonds should be able to protect you when equity markets are going down. But in the current environment with high inflation, both are similarly correlated. So the question is, can we do more? I mean, can we find out other alternative asset classes that can be complementary to your stock bond allocation and help you, get that uncorrelated return and generate a risk-adjusted basis as well? And to that extent, I think, we have been observing and seeing allocations that can go into alternative asset classes such as commodity, gold, REITs. Singapore REITs have done phenomenally well. I mean, if you see on a relative basis, they've been flat for the year versus the US REIT market or the global equity markets being down double digit, plus even like allocation to emerging markets and international markets. So these are, I mean, in the new paradigm of investing, if you were to think about asset allocation, it needs to go beyond, the traditional stock bonds.
Yeah, so the question was, in the Syfe core portfolios, we do have an allocation to China. The question was, given what's happening in the market, how do we think about the China allocation and how do we think about portfolio rebalancing?
Sure, thank you. Yeah, so that's a great question. And in fact, in terms of how we think about asset allocation, we actually do not want to take a view on the markets. So we believe in systematic investing in a more passive manner. But at the same time, what we have done is kind of incorporate certain factors that can generate you risk-adjusted returns on a longer-term basis. So we've identified factors, whether it is value versus growth, whether it is allocation to the more emerging markets that's implemented in a way by allocating a certain percentage to China. And as well as like minimum volatility and such other factors as well. So all of these factors are supposed to generate you systematic, returns on a risk-adjusted basis on a long term. When we think about rebalancing, it happens once every 6 months. So we don't try to, time the market and say that now we believe China is going to rally or some other markets are going to rally. So we don't take those positions, but we have these kind of integrated as part of our portfolio construction process. And what that means is essentially, while China, if you look at 2020, 21, especially 2021, they went through a pretty rough time, but it's part of our strategic asset allocation. And what that means is over a longer term basis, the diversification benefits that Clara mentioned, you saw the A-share, as well as the offshore market, how from a correlation standpoint, it adds diversification benefits to your portfolio. So we have a strategic allocation. It is roughly between, I think, 5% to 15% of our portfolio allocations. And what that means is you enjoy that diversification benefits and enjoy that sort of risk-adjusted returns in the long term without having to worry about the ups and downs that you see on a more near-term basis. If you look at China, I think one of the aspects that you will realize is China is volatile. I mean, there is some policy or regulatory aspect that comes into China and impacts the equity markets, I think, every year or every other year. But investors do get compensated for that extra risk that they're taking with the China exposure. And that basically means if you hold it long enough, the portfolio overall will yield you good results.
Yeah, if I could just add to that. So the way that I know, similar to what Clara mentioned before, so Ritesh, it's position sizing, right? So how much of China do you own? And typically, if you sort of go by, how much is it represented in an index? It tends to be about 5%. If you look like the global equities, both developed and emerging, so it's about 5%. But if you look at how much China contributes to GDP, right? It's if we use like PPP, so like purchasing power parity dollars, it's almost 20%. It's about 19% as of 2021. And when we think about how much should our portfolios have for China, of course, it's risk adjusted. So, there is a range. But we think, okay, maybe, going by like the lower bound of 5 and an upper bound of maybe 20, right? So depending on your risk appetite, that position will be sized down because China, as I think you saw in one of the charts, right, the range has been one of the widest over time. Yeah, okay, let me check. So we have one more question about China that I think would be a good segue, but if anyone else wants to ask a question, please feel free. Okay, you can go.
Vietnam is still classified as a frontier market within ASEAN. So unless you're looking at MSCI all country ASEAN, which is unfortunately not how we had broken it down, but that's essentially why. And Vietnam has hurt pretty significantly this year. I was actually just chatting with the Vietnam Opportunities portfolio manager a couple of days ago and trying to understand what's going on. And it's really nothing fundamentally wrong with Vietnam's equity market. It's just that there's been a really good run over the past couple of years or so, and people are just profit taking in that space. But if you think about Vietnam as an opportunity set over the longer run, I think it's going to be a really major beneficiary of a lot of these MNCs that currently have operations in China that have, really been shocked by the degree of the enforcement of the COVID-0 policy, and how has that disrupted their businesses such that they have to start thinking about, how do we make our businesses more sustainable? And one of the ways that they can do that is to really outsource to all of these other frontier ASEAN countries, and Vietnam is one of them that keeps coming up. And if you were to look at the foreign direct investments that's been going into Vietnam on a year-to-date basis, it's been the outperformer versus all of the other countries within ASEAN as well. So over the longer term, I do think that there are good opportunities there, and that the sell-off this time that we're seeing is relatively deep, but could be a good buying opportunity.
So I guess like we have a healthy mix because we take the broader index, right? So it's got the A share, H share, and all the different components. If you want a more dedicated exposure to China, then we do have a China growth portfolio where you do see some of the more A share components coming in. Yeah, and more consumption driven in the future looking China as well. Yeah. Plus, I think we do have our custom portfolios too. So, over there, the options, further increase. If you want more dedicated kind of exposures that way, you can self-construct your portfolio too. So we do espouse like what is called like a core satellite investing framework where bulk of your portfolio should be invested in a diversified manner globally across asset classes. And then you add these satellite investments where you have high conviction in. Yeah, so it's ETFs only at this point of time. So you can choose a few ETFs. You can select whichever ETFs you believe. So it's managed by you. You decide. But what we do for you is make it really easy and simple to understand what exposures you're getting, right? A lot of other places, I think what will happen is if you're trying to construct your portfolio, it becomes really tough to understand like which ETFs to choose or which components to choose, how much allocation should be given, what exposures are you getting, how are the historical returns, what kind of risk am I taking? These are things that are kind of pre-built as part of our custom portfolio offering. As you dynamically change allocations, it will change the exposures and everything. Plus, it's got unlimited edits, so you can construct your portfolio over time. You think things are changing, you want to reallocate, you can do all of those by yourself.
Yeah, thank you for all the questions. So we have a few more coming in. I think we'll sort of go back to more macro. So you mentioned that one of your highest conviction calls right now is U.S. investment grade bonds. So in an event of a recession, I know you're saying hiding right and being paid for it. Yeah, how would that exposure hold up?
Yeah, so definitely you'll see some, okay, let me take a step back. In every credit exposure, there are two main sources of return, right? Because you have the return that's coming from your interest rate duration, and then there's the return that comes from the spread. So whether spreads are compressed or they widen, you can get a return off of that. So definitely in a recessionary scenario, you're going to suffer losses from the spread component of returns, right? Because spread widens and then you lose money on that front. But historically, on average, over all of the recessions going back to the 1970s, if you look at the amount of loss that has been experienced from a spread component is about 2%. And then if you look at the gain that you get from the fact that there is a recession, rates are falling, and then overall investment grade is a higher duration exposure, the gain that you get from the interest rate piece is much higher. So on average over recessions, that's about 8%. So historically, like if you were to be in a recession, yes, you will suffer losses from the spread perspective, but that will be more than offset by whatever gain that you can get from the interest rate duration perspective. So I think it will still hold up relatively well in a recessionary scenario.
Yeah, thank you. Okay, so we're going into China real estate, because I talked about it a little bit just now, but there have been, just a lot more government support, right? And sort of reforms around that space. But then there are also a lot of debt problems that have been going on for quite some time. So where do you sort of see that for the rest of the year until 2023?
Yeah, I think China has an unenviable issue that they face in the property market right now. But I think, I think they recognize that this is not the time to do significant deleveraging, just because there's already so many of these developers, especially the privately owned ones, that are experiencing difficulties with funding and completing projects as a result of the deleveraging rules that they had set almost a year ago with regards to the 3 red lines, right? So I think for now, the focus of the Chinese government should really be to contain the deterioration in confidence in the property market that's related to incompleted projects. So, I think we've already started to see some very decisive action from the central government, which is always encouraging. To set up a fund to that is initiated by the Chinese Construction Bank to kind of help these problematic developers complete their projects so that they can deliver it to the homeowners who are now refusing to pay their mortgages. So I think a series of more decisive actions on the central government's part to kind of clamp down on this deterioration of confidence is actually the biggest task at hand, I would say, for the Chinese government with regards to the Chinese property market.
Okay, Yeah, just want to contextualize a bit because for the Syfe core portfolios, right, we don't have any Chinese property exposure. So for you, for those of you who have any of our growth, balanced, as well as defensive portfolios, which have some fixed income exposure, right? So that's all investment grade. That is very, so that's mostly like government, corporate, and then government related. So yeah, very limited exposure, if any. And for our global income portfolio, which tend to be like yieldier, so you're going after the spread sectors, trying to gain that coupon, so clip that coupon, and then mitigating some of what you could potentially lose out from duration, because these sectors tend to be less duration sensitive, but more credit sensitive. So for that, there is still a very small allocation to the Chinese property overall. Okay, and then lastly, if I could end on one last question. I know we still have a few, so if any of you have asked or have more questions to ask, please come and talk to us, and then your advisors will be around as well. So more than happy to chat afterwards too. But let's end off with energy, like one of the best performers for this year so far. Given that a lot of the if you look much more longer term, like a lot of these companies from a risk return perspective have not really kind of delivered relative to other sectors, even though they had a stellar year this year, and I think for most of 2021 too. So with now that we see on the inflation side, so the prices are coming down, and if the world does go into recession, right, what's your outlook for these companies?
Well, I think I want to speak specifically to U.S. energy because I think that's probably the biggest chunk of exposures that we have, and I think historically, like companies that have not really been the best in terms of constructing like good balance sheet, having capital expenditure discipline. But then after the 2014 kind of oil meltdown, we started to see a lot of more companies introducing capital expenditure discipline, such that if you were to look at the free cash flow yields of these energy companies now versus before, it's improved very, very significantly. And also, from a valuation perspective, despite the phenomenal run that we've had in energy stocks this year, they're still below average in terms of valuations and are still trading at a discount to the S&P 500. So I think from that perspective, the fact that the companies themselves have already reformed in the U.S. energy space, on top of that, they're still relatively cheap relative to the broad market and also versus their own history. It's pretty good to have kind of a more evergreen exposure to this space to kind of leverage, in times when you have high inflation, right? Energy sector was the only one that was, aside from commodities, that kind of protected you in this downturn. So I think having an allocation there would make sense, given that it's not expensive to own.
Yeah, before I invite Dhruv, Arora, our CEO and founder, just want to see if there are any more last questions in the room.
Thank you so much. Firstly, nice to see everyone. I think this does bring us back to the very early memories of building Syfe, where in-person events were quite the norm. I think we are working on a hybrid setup these days, so a few people in person and a few online. But it's wonderful. Thank you, all of you who are here, and thank you everyone who are joining us online as well. Thank you, Clara, for sharing some valuable insights. I think when we started Syfe about 3 years ago, we had a very simple premise, which was how can we give institutional quality, high quality investment, financial wealth management solutions to everyone. And when I entered the room today, it took me back to my time at UBS, where I was for quite some time, where we would have, again, our HNIs, UHNIs in a very similar type of setup. With the power of technology and the lovely team that we've assembled, we continue to hope to deliver on such high quality advice, access and affordability, the three pillars of building Syfe. We are now about 100,000 plus users in Singapore. That nearly covers about, say, 3 to 4% of Singaporean adults. We launched Hong Kong 2 months ago. We launched Australia yesterday. But this doesn't take anything away from what our home is, Singapore. So look forward to some really exciting products and offerings coming across the next few months and quarters in Singapore. And with that, for everyone who's joining us online, thank you for joining us. And everyone who's here, I look forward to meet you right after the session. Thank you again and have a lovely evening.